Good morning. Today, our group will be presenting on the next topic, which is group audit and using the work of others. But before we go deeper into this topic, we should know who performs this group audit. It is performed by a group of auditors who are responsible to give audit opinion on the group financial statements. The objectives are to prove that it is appropriate to work as a group auditor, and the group auditor should gather sufficient and appropriate evidence in order to reach an opinion on the consolidated financial statements. So, what is group audit? Group audit is the audit of group financial statements. Meanwhile, group financial statements are the financial statements that include the financial information of more than one component. It also refers to combined financial statements, aggregating the financial information of components that are located under the common control. Components here means an entity or business activity for which group or component management prepares financial information that is required to be included in the group financial statements. Example of components here are like subsidiaries, divisions, geographical locations, investments, products and services, functions, processes, component units of state, local, and governments. There are 3 stages involved in planning of group audit, but first, we need to know why this planning is important. It is important because the group auditors need to have a good understanding of the structure of the group, the significance of each component of the group, the mechanics of the consolidation process, and the risk of material misstatement presented by each of the company's financial statements. These maturity levels need to be established for the group overall and for the individually significant purposes. Basically, there are 3 stages in planning of group audit. The first one is gathering evidence on the components, whereby the group auditor need to be involved with the work of component auditors. In a group, it is likely that some companies will be audited by a different firm of auditors. So, the group auditor cannot just simply rely on another auditor's opinion on the financial statements. That is why the group auditor need to review a report of work done by the component auditor. They may issue a questionnaire highlighting on certain issues arising from the audit for another auditor to fill in. Next, to make sure that the audit is free from financial or material misstatement, they can review the component of overall audit strategy, perform risk assessment, attend close meetings with the component auditor and the company, or review the component auditor's paperwork. The next stage is stage 2, auditing the consolidation. The group auditor must plan the audit procedures to be performed on the consolidation process. For some groups, the consolidation is so much complex and it is likely to involve some areas of judgment, and so there is a high degree of audit risk. A thorough planning will be essential to make sure that the audit risk will be minimized. The type of audit procedures that can be performed by this group auditor is to check whether the figures taken into the consolidation have been accurately extracted from financial statement or not, and then to evaluate whether the components of the group have been correctly identified and classified into subsidiaries, associates, or joint ventures. The third one is to review the necessary disclosure in the group financial statements, such as related party transactions or monetary interests. And they can also gather appropriate evidence to the specific consolidation adjustments made necessary by the financial reporting standards, such as the calculation of goodwill and its impairment, or the cancellation of intercompany balances and transactions. So, we have come to the last stage in planning the group audit, which is stage 3, issuing the group audit opinion. The group auditor issues an opinion on the consolidated financial statements. This is done after a thorough review of all evidence gathered in the first and the second stages just now.
The next subtopic is on principal auditor. Who is a principal auditor and another auditor? A principal auditor is the auditor with responsibility for reporting on the financial statements of an entity where those financial statements include financial information of one or more components audited by another auditor. Whereas another auditor is an auditor other than principal auditor with responsibility for reporting on the financial information of a component which included in the financial statement audited by principal auditor. Other auditor include affiliated firm and unrelated auditors. What are the rights and responsibilities of a principal auditor? A principal auditor is responsible to perform the audit and give opinion on the consolidation account under Section 174 subsection 2. The rights of principal auditor is: first, access to the accounting and other records of the company and any subsidiary of the company. Second, require from any other auditor of related company for any information and explanations required for the audit. Third, require from any officer of the parent company and the officer of the related company to get the information and explanations required for the audit. In order to accept the appointment, the principal auditor should consider the following, which are: first, materiality; second, knowledge; third, risk; fourth, extent; and the fifth one is competence. The first one is materiality of the portion of the financial statements which the principal auditor audit. Second, the principal auditor's knowledge of the business of the component. Third, risk of material misstatement in the financial statement of the component audited by other auditors. Fourth, the extent of the additional audit procedures by principal auditor. And last, competence of other auditors also need to be considered. The scope of work of the principal auditor is depending on: first, scope of work of other auditor in terms of the terms of engagement of other auditors, any limitation, standard of work and independence of other auditor. Second, any problem encountered in the past. Third, any significant changes of component condition, business and profitability. Fourth, inherent risk assessment of subsidiaries by the principal auditors. And last, materiality of component compared to group as a whole. Misstatement in a component may not be material for the group as a whole, but combination misstatement of a few components might be material. What are the procedures of principal auditors? For preliminary stage, to obtain and prepare schedule of investment in subsidiary showing opening balance of investment in subsidiary, additional or disposal of investment, ending balance, check accounting treatment for gain or loss on disposal of disposal, confirmation the existence and ownership of investment, obtain audited account or management financial statement of each component. For detailed audit work, checking the consolidation figure on goodwill or reverse arising on consolidation, pre- and post-acquisition reserve, overall reconciliation and movement, calculation of minority interest, agreement of intercompany balances, adjustment and cancellation of intercompany transaction and balances, proper use of foreign currency rate for translation, and make sure properly disclosure the necessary items, related party transaction, company level and group level. For questionnaires, it is given to other auditor which include confirmation regarding: first, internal control of subsidiaries; second, basis of accounting policies; third, balance sheet items; fourth, profit and loss items; Fifth, exceptional transaction involve director and general matter. Sixth, any limitation of scope facing by other auditor. And last, any qualifications and the reasons for them. Review of other auditors' working papers. It is to ensure, first, system examination and documentation of auditor is appropriate. Second, tests of control and substantive tests have been properly carried out. Third, working paper is comprehensive. Fourth, review process of working paper has properly been done. Fifth, the financial statement follow accounting standard. Sixth, auditing carried accordance to approved auditing standards. Seventh, adequate evidence obtained as a basis to form an opinion. And last, identify the intergroup transaction.
As the auditor, the objective is to, first, perform specific audit procedures to identify the instances of non-compliance which have a direct impact on the financial statements. Second, to obtain sufficient appropriate audit evidence regarding the laws and regulations which have a direct impact on the financial statements. Third, to respond appropriately to non-compliance or suspected non-compliance with laws and regulations identified during the audit. Now, the impact on the financial statements. The provisions of laws and regulations may either have a direct or an indirect effect on the reported amounts and disclosures on the financial statements. Non-compliance may result in fines, penalties, litigations, or other consequences for the entity that may have a material effect on the financial statements. Responsibility for compliance with relevant laws and regulations. It is the responsibility of the management, with the oversight of those charged with governance, to ensure that the entity's operations are conducted in accordance with the applicable laws and regulations. Move on to auditor's responsibility. First, to identify material misstatement in the financial statement due to non-compliance. However, auditor is not responsible for preventing non-compliance and cannot be expected to detect non-compliance relating to all laws and regulations. Second, to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether caused due to fraud or error. And the third one, for which have a direct impact on the material amounts and disclosures in the financial statements, the auditor's responsibility is to obtain sufficient appropriate audit evidence with regard to the non-compliance, but for which does not have a direct impact on the financial statement, but their compliance is fundamental to operating aspect of the business or to avoid material penalties. The auditor's responsibility is limited to undertaking specified audit procedures to help identify non-compliance with those laws and regulations that may have a direct impact on the financial statements. Now, I would like to highlight few main points under the auditor's consideration for compliance with relevant laws and regulations. The auditor shall obtain a general understanding of the following. 1. The legal and regulatory framework applicable to the entity or sector in which the entity operates. 2. Entity's compliance with the relevant framework. And then, the auditor shall obtain sufficient appropriate audit evidence regarding compliance with other laws and regulations generally recognized to have a direct impact on the determination of material amounts and disclosures in the financial statements. Then, the auditor shall perform the following audit procedures to identify the instances of non-compliance. First, inquiry with the management, and then inspecting correspondence, if any, with the relevant licensing or regulatory authorities. Followed by maintaining professional skepticism throughout the audit. Lastly, to obtain a written representation from the management stating that all the instances of non-compliance or suspected non-compliance with laws and regulations have been disclosed to the auditor. For the audit procedures to be performed when non-compliance is identified or suspected, first, if the auditor is aware of the information concerning an instance of non-compliance or suspects in non-compliance, the auditor needs to obtain 1. An understanding of the nature of the act and the circumstances under which it has occurred. Further information to evaluate the possible effect on the financial statements. Then, if the auditor suspects that there may be a non-compliance, the auditor shall discuss the matter with the management, those charged with governance, and also obtain external information. In case to obtain sufficient appropriate audit evidence relating to non-compliance cannot be obtained, the auditor shall evaluate the lack of sufficient appropriate audit evidence on the auditor's opinion. Reporting of identified or suspected non-compliance. First, reporting to those charged with governance. Unless all those are involved in the management of the entity and are not aware of the matters involving identified or suspected non-compliance already communicated by the auditor shall communicate with those charged with governance relating to non-compliance that comes to auditor's attention during the course of audit, other than the matters that are clearly inconsequential. If, in the auditor's judgment, the non-compliance is believed to be intentional and material, the auditor shall communicate the matter to those charged with governance as soon as practicable. If the auditor suspects that management or those charged with governance are involved in non-compliance, the auditor shall communicate the matter to the next higher level authority of the entity, if it exists, such as an audit committee or supervisory board. Where no higher level authority exists, or if the auditor believes that the communication may not be acted upon or is unsure as to the person to whom to report, the auditor shall consider the need to obtain legal advice. Now, let's move to related party transaction. What is a related party transaction? A related party transaction is a deal or arrangement between two parties who are joined by a pre-existing business relationship or common interest. For example, a contract between a major shareholder of a corporation and that corporation, agreeing that the shareholder's company will renovate the corporation's offices will be a related party transaction. The most common types of related parties are business affiliates, shareholder groups, subsidiaries, and minority-owned companies. While related party transactions can include sales, leases, service agreements, and loan agreements. The Financial Accounting Standards Board considers related party transactions to include transactions between A. A parent company and its subsidiaries. B. Subsidiaries of a common parent. C. An enterprise and trust for the benefit of employees. D. An enterprise and its principal owners, management, or members of their immediate families. And E. Affiliate. Related party transactions occur often in the normal course of business because the parties to the transaction are not at arm's length and may not push for the best bargain, which may be a detriment to the corporation's profits. Now, move on to the next subtopic.
Now, move on to goodwill on consolidation. As we all know, goodwill is an asset generated from the acquisition of one entity by another. It arises during business combinations when the price that one company pays to acquire another firm is greater than the value of the target firm's net assets. For the computation, goodwill is equal to consideration paid plus fair value of non-controlling interest minus assets acquired minus liabilities assumed. Apart from that, in consolidation of goodwill, Once goodwill has been recorded by the acquirer, there may be subsequent analysis that conclude that the value of this asset has been impaired. If so, the amount of the impairment is recognized as a loss, which reduces the carrying amount of the goodwill asset. Since goodwill is an intangible asset, it's recorded on the balance sheet as a non-current asset, meaning it's a long-term asset similar to fixed asset like property, plant, and equipment. In auditing, guidelines for auditors in verification of goodwill is: firstly, in case of purchase of the business, the auditor should verify it with the help of the agreement made with the vendor, which shows the price paid for it. However, if the amount of goodwill is not specifically mentioned, it is to be treated as the difference between the purchase price paid for the business and the net assets taken over. Secondly, in case of revaluation of assets, which has raised the goodwill account in the books of a company, the auditor should refer the basis on which the assets have been revalued. While in the case of goodwill, which has been written off but later brought back to write off capital loss or the debit balance of profit and loss account, he should investigate the period over which the goodwill was written off and also ascertain the amount of goodwill. Then, he should see whether debtors as well as shareholders approve it by passing necessary resolutions in the meeting. Last but not least, in the case of partnership firm, he should verify the partnership deed. He may also verify the changes made in the goodwill account from time to time based on the provisions made in the partnership deed. Now, move on to using the work of other auditors. According to AUD689, when the principal auditor uses the work of another auditor, the principal auditor should determine how work of the other auditor will affect the audit. Then, the principal auditor should lead the planning, especially the timing of the group audit, the specific risk area and audit procedures, intercompany balances, etc. The principal to discuss with other auditor to synchronize the audit work, and the other auditor should cooperate with the principal auditor. For example, to advise principal auditor for any significant event that may have an important impact on the audit of consolidated financial statements, or maybe to inform the principal auditor any matter that has not been carried out as requested. Apart from that, the principal auditor needs to satisfy that all material areas of the financial statements of the subsidiaries have been audited satisfactorily. In evaluating the work of other auditor, the principal auditors would advise the other auditor about: first, the independent requirements, and obtain from the other auditors a written representation that they have complied with independence issues. Second, the accounting, auditing, and reporting requirement, and obtain from the other auditor a written representation that they have complied with accounting, auditing, and reporting requirement. Third, the principal auditor would inform the other auditor of matters such as areas requiring special consideration, procedures for identification of intercompany transaction for disclosure, and also timetable for completion of the audit. Lastly, principal auditor should review the audit procedures applied, review a written representation of the other auditor, and review working paper of the other auditor. Once reliability of the work carried out by the other auditor is in question, the principal auditor should perform a detailed review of the other auditor's working paper and give attention on: first, existence of proper documentation of audit work carried out by the other auditor. Second, adequacy of the audit programs. Third, scope of work covered by the other auditor. Fourth, give attention to whether appropriate tests of control and substantive procedures have been performed, and then whether adequate audit evidence are obtained. And the last one is whether work carried out by the engagement team are being adequately reviewed. So, if the principal auditor is not satisfied with the working paper, the principal auditor might request the other auditor to perform the supplementary test, or alternatively, the principal auditor might need to perform the
Now
test.
I will talk about using the work of an expert. As auditor, there are times for certain assertions requires an expert opinion and involvement. Expert here means a person possesses special skill, knowledge and experience in a particular field other than accounting and auditing. An expert may be engaged by the entity, engaged by the auditor, employed by the entity or employed by the auditor. When determining the need to use the work of an expert, auditor would consider the materiality of the financial statement item being considered, the risk of misstatement based on the nature and complexity of the matter being considered, and the quantity and quality of other audit evidence available. Now we move to the audit procedures by using the work of an expert. The procedures to be performed by the auditor are: first, to ensure that the expert is professionally competent to take up the engagement. Second, to assess the objectivity of the expert. Third, the auditor need to consider the objective of involving the work of an expert, the scope of work of the expert's work, and the assumption and method used by the expert. Fourth, the auditor of course does not have the same expertise and knowledge with the expert. However, based on knowledge and experience should go for appropriateness and reasonableness of assumption and method by the expert and figures reported. Fifth, the auditor should assess the appropriateness of the expert's work as audit evidence regarding the financial statement assertions being considered for as a basis of opinion. Last but not least, reporting considerations by using the work of an expert. If an expert does not provide sufficient audit evidence, the auditor still have to resolve the matter by discuss again the management and the expert and applying additional procedures including engaging another expert if required. If it's still unresolved, the auditor may modify the audit report that is unqualified opinion with emphasis of matter, or auditor may issue a qualified report. So that's all from our group. Thank you. Now we move to the last subtopic in this chapter, which is considering the work of internal auditor. In this case, the external auditor should consider the activities of internal auditor and their effect, if any, on the external audit procedures. By using the work of internal auditor by external auditor, it is a shortcut in performing audit procedures for the purposes of expressing opinion. An external auditor may review of the work of an internal auditor. Internal auditor would be able to advise the external auditor on important issues so that the external auditor can be more focused on their job. During the planning stage, the external auditor should first of all understand the internal auditor's scope of work, function, and objective. It is different to the external auditor because the external auditor should not rely on the work of the internal auditor. Also, the internal auditor function will influence the external auditor's judgment about the nature, timing, and the extent of the external audit procedure. It is important to ensure that the work of internal auditor is able to complement the work to be performed by the external auditor, which is to express the opinion on the financial statement. Therefore, the external auditor, in order to accept the work of internal auditor, should evaluate the internal auditor in terms of: first, technical competence, which is the skill and the expertise of the internal auditor. Second, the professional due care, which is the process of internal audit with due care. Third, scope of work, which is audit evidence obtained insufficient and appropriate for external auditor to form an opinion. Fourth, the documentation on planning of internal auditor. And lastly, the sample size selected by the internal auditor.